Hello and welcome to the latest edition of Citrus Mortgage Bites from our offices in Sevenoaks. I'm Richard Harris and I'm delighted to be joined by Holly Bettles, Mortgage and Protection Advisor for CitrusFinancial. Holly, I'm going to come to you in a second, but before I do, I'm mindful that this is, I think, our first conversation since the Bank of England base rate change, which seems like an age ago now, to 5%. But before I do, I was checking back over some of the things we've talked about over the last kind of 12 months or so. And I was thinking back to last year when I think it was about 1.4 million homeowners were facing mortgage products, fixed rate mortgage products coming to an end. The figure this year, I think for 2024 is about 1.6 million. We had time talking about the cost of living crisis and the impact inflation was having on people. And how rates obviously peaking at 5.25 and what that meant with some of the fixed rate products as well. And all of that really great stuff that actually, when you boil down to it, there were some real concerns about the impact on budgets, understandably, some real impact about what it would mean to the housing market. And then I decided to just pick up the July, which is the most recent version of the Halifax House Price Index. And I have to say, it really, really shocked me. And I thought I'm just going to cover that briefly. But annual growth rate for house prices was up to 2.3% in the July version of the house price index. And average house price now stands at 291,268, given it will depend where you live. I understand that. And comparing that back to December 2016, when it was about 219,544, I think, at the end of 2016. And the final thing I saw before I come to you is the year-on-year Bank of England statistic for mortgages approved to finance house purchases compared to June 2023. So when you're comparing June 24 to June 23, was up by 11.7%. So I sat here thinking, I must have missed something. I can see all of this amazing stuff, and I will invite Matthew Cumber, who comes to talk to us from Countrywide Surveyors about what's going on in the housing market. But I thought that I must have missed a mortgage sale, and that maybe lenders have been giving stuff away. I hadn't been aware of it, but I'd love to get your view on, this is just an amazing conversation to be having based on what we've talked about for the last 12 months. So tell me, have I missed a sale, or what is it that lenders are doing to try and help stimulate this market to a way that prices are continuing to go up?
No sale, promise. There's nothing amazing that we haven't told everybody about or anything particularly, fantastic that we're keeping to ourselves. We've seen a really, really busy kind of June, July, August, with lots and lots of people moving. So what we're seeing is backing up kind of what you're reading, Richard. And I think a lot of that is down to the lenders kind of having a look at their criteria, what they are able to change, what they aren't able to change, but focusing on those things that they can look at, which means borrowing is that little bit easier. Yes, cost of living is around and things are more expensive, but obviously with the base rate drop, interest rates are better now than they were kind of 6 months ago. All those things have helped towards people really having an appetite for moving and looking and seeing whether they can get on the market or upsize or do any of those things that people are looking to do. So things like extended terms on mortgages, where we can take, income up to the age of 75 with pretty much any lender now. Looking at deposit options, being able to do things with new build companies and help people get on the ladder with a smaller deposit. A couple of companies have got income boosts for first-time buyers as well. So as long as you hit criteria, then you're looking at being able to borrow more. Obviously, they have to do it in a sensible way. They have to be careful. They have to stick in with FCA regulation. But all of those things are happening in order to try and keep the mortgage market going, keep the borrowing afloat, and keep the house prices stable or increasing, as we've seen.
Yeah, interesting. Thank you. And clearly, lenders are or have responded to the market they were facing. And maybe for people watching this who have been on the sidelines or trying to time that perfect, we hear a lot about people going, well, I'm not sure now is the right time. And I know, kind of what people talk about there about was individual circumstances. But from your perspective, have you got an example of a typical rate? So if I'm a borrower, and I know it may depend how much deposit I've got, whether I'm a first-time buyer, etc., but give us a flavour how the Bank of England base rate changed, what sort of impact has it had on some of the fixed rate products on the market?
Yeah, so any of you who kind of read the newspapers and read the headlines will be aware that if you're looking at a kind of a bog standard 60% loan to value kind of scenario, those 6 months ago, they would have started with a four, 4.5%. If you're looking at now and that kind of loan to value bracket, it's starting with a three. Yes, it's high threes, but it's starting with a three. And for people coming off a fixed rate or looking to move, that is going to make a massive difference to their monthly payments.
Yeah, and it's also interesting, actually, thank you for that, how the 0.25, the 25 basis point drop in base rate actually can equate to something different than 25 points basis points, right, when it comes to kind of fixed rate products, etc., because of the way they're priced differently. So that's really, thank you for that. And I say we'll invite Matthew to come and spend a bit more time trying to work out the whole supply and demand piece around house price, what's going on with it. But interesting to know what lenders are doing to try and create that kind of mortgage side and affordability. And it kind of leads me on to my next question. This is a bit of a spotlight area. Whenever we get to talk, Holly, I try, and I know we discuss, have we seen maybe conversations that stand out over the last couple of months where we think, we've had more inquiries that maybe we ought to be talking about this. And the area that came to light when we spoke was clients who are divorcing, separating, and the position they find themselves in and what they can do. And clearly that is already a hugely challenging time. And I won't go into the personal aspects here, but I appreciate lots of different scenarios, particularly where there might be children involved and schools are involved and commutes to work are involved and family support and all of those things. So just, bear with me. And then I come to the question, because I decided to dig into this a little and just go, well, what is it that sort of the market says around people who are divorcing? Interesting, the divorce stats themselves sort of are at their lowest level since 1971, but I think there's some hidden bits in here. And the number of people divorcing within 10 years compared to the 1995 statistic, actually the most recent one was the 2012 to 22 grouping, and the number has gone down slightly. However, there was a very interesting survey done, and admittedly it was kind of 18 months ago now, but by Zoopla. And it said a third of those who purchased property together but then broke up, actually then subsequently broke up. And 47% of the people in their survey are still sharing a mortgage with an ex-partner, mainly because the cost of moving out is just so prohibitive. So you've got a situation where where you've got kind of parents involved, the number of parents both working full-time has continued to go up over the last 10 years. So you've already got that situation where both parents are working full-time. They're saying, actually, the amount of time we're spending together after separating has continued to go up because they just cannot see how to get out of the situation they find themselves. And one of the biggest reasons for this is the accommodation piece. It's actually, we can barely afford to cover the mortgage that we've got now. How on earth would we cover two mortgages? So I thought it'd just be worth spending a bit of time going, so if we find ourselves in this situation, what is it that people can actually do when they're trying to find an alternative?
I think it very much depends on what that individual is really looking for, and I think that's what we have to focus on when looking at this kind of situation. There are going to be lots of influences that come into play here with regards to whether people are wanting to stay local to work or local to the kids' schools or have enough room to have the children stay over, those sorts of situations. And really it's about sitting down with a client, working out what they need, working out what that will cost, purchase price wise, and then looking at their situation. And for some clients, they're really lucky. They earn enough to be able to take the property on themselves or to be able to take enough money out of the property to be able to start again. But again, this is where the lenders come into play, and the fact that they're well aware that these are scenarios that they see day in and day out. And therefore, there are a few different things that lenders can do. So if it fits basic affordability, then we'd go down the route of either, say, buying one half of the couple out, or taking some money out to pay off another half, and to keeping the property, or taking the deposit from the equity and then moving them into somewhere else. But there is also the option where if it doesn't fit that basic affordability, you can go and talk to the lender. They'll often put a note on the file just to make sure no changes can be made without both parties being involved, or at least notified of it. And then they will look at the situation and try and help as much as they can. So we've had a few clients where it doesn't fit basic affordability, but because they can see the situation and they can see what's happening, as long as you can evidence that you're able to manage those finances, then there are instances when they'll go outside of the normal, standard size box and see if they can help there. If that's not the case either, and your existing lender can't help, there are some kind of newer lenders on the market who are looking at this from a different perspective and going, okay, we can see that there is a massive boom here. We can see what people need. How can we finance our borrowing differently to be able to present a product that works well for these people? So in that situation, again, it comes back to that term and that lending into retirement piece. But there are some lenders who are going, we can finance our money some way. That means we don't have to put an end date on this mortgage. We can run it. And that's really helpful for people who are maybe in their 40s or 50s, who are looking essentially to start again on the property ladder in some respects. And that time before would have been against them. But actually, there's potentially some options now to look at and to consider.
Okay, thank you. So I think I'm hearing, the lenders are very aware of this. They are looking to help where they can. Ultimately, therefore, it's kind of a talk to a lender or talk to a mortgage broker and someone who can go through all of these different scenarios. And as much as obviously it's a group, because they're sensing there is a group of people really needing this, actually it's quite individual, isn't it? And therefore, talking to someone about your own individual circumstances, working through all of that affordability is really important. And maybe we just touch very briefly on, I haven't got lots of time today, but touch very briefly on that lending into retirement, because that sounds like a knock-on impact. There's lots of different scenarios, whether it's first-time buyers, whether it's kind of people who are needing to separate. What are we seeing change around lending into retirement?
I mean, the bog standard 20, 25-year mortgage doesn't really exist anymore. If you've got the affordability and we can save the interest, absolutely, we look to do that for you. And we'll always try and do the shortest mortgage term possible. But, for the most part, because of cost of living and the cost of house prices and how difficult it is to get a deposit, people are borrowing a lot. And therefore, in order to make that affordable on a monthly basis and for lenders to be able to legitimately say to the FCA, look, we are responsible lending here, they are pushing the boundaries as far as they can in regards to how long they can use that earned income for, because I think they've realized, as much as maybe some of us have, that retirement at 66 or 67 probably isn't going to be as in reach for some people as it may have been in the past, and therefore we will likely be working later. And they've realised that actually, if that is the case, people can work later, they can pay their mortgage until later, and therefore they are stretching those terms where they can. You might need to sign a form, there could be all sorts of, different hoops to jump through. Some lenders are easier about it than others, but actually, again, it's just something that they're looking at and going, this is a lever we can pull. It will massively help. We can back it up to say, these are the reasons why we can do it. And therefore, that is helping me to be able to get, helping brokers to be able to get lending through that maybe we couldn't have done 5 or 10 years ago.
Okay. Holly, thank you. These are obviously, particularly today, really difficult subjects to talk about, and I thank you for kind of just explaining them nice and clearly over what people can do. The message I always come away from, especially when we've spoken, is about, talk to someone, talk to a lender, talk to a broker, talk to someone who can actually look at your individual circumstances. So thank you very much. Thank you for everything today, Holly. Much appreciated. That's all we've got time for. Bank of England base rate. Well, the next change is the middle of September. We'll obviously keep you posted over what's happening, what happens to the Bank of England base rate, what that means for mortgage rates in our net Citrus Mortgage Bites. Until then, thanks ever so much for watching. Take care and bye for now.